Hi, everyone. Welcome to another very special Carson webinar with Ryan, Detrick, and Sonu. We'll give our titles and things here in a second. Sonu, it's an election year. There's a lot going on. We titled this Managing Your Wealth, and I added and Sanity in an election year. I mean, how are you hanging in there this election year so far, Sonu? You doing all right?
I just took a sabbatical. That's how I'm hanging.
You just left. You still, you know what? You should have taken off October and November. You didn't plan that right.
Like, no, I didn't.
That's funny. So I'm Ryan Detrick, the Chief Market Strategist with Carson. Been with Carson over 2 years. Get to work with so many of you out there, and you've probably seen a lot of the cool stuff that Sonu and I do, and our research team here at Carson. But it's been a lot of fun. Sonu, tell me something about you I don't know. Anything about you I don't know? What's going on out there?
Well, you know the fact that Vice President, Global Macro Strategist, what you don't know is, oh, I like listening to Euro dance pop music when I'm in the afternoons when I'm working because it just picks me up.
There we go.
You can't fall asleep when that stuff is on. See, there you go.
That sounds like bull market music, and we are in a bull market. Believe me, we're talking about the election and all these things, but hey, we're still in a bull market. We're going to get into that, so that's fun. But Sonu and I are excited. We're going to keep this about 40 minutes or so. I probably need to keep track of what time. Well, Sonu, you just tell me. But yeah, I think 40 minutes. I got it. Yeah, we've got some other things going on, but we are excited that everyone could join us today as we talk about the election. But Sonu, I think it's really important, right? We did release our mid-year outlook. Hopefully a lot of people had a chance to see that. We called it Eyes on the Prize, and I think it's really important. The last 7 years, stocks have doubled. The Dow went from 20,000 to 40,000. But just think about all the things that have happened, right? Terrible wars, assassination attempts, an economy that slowed down drastically a couple times. You had an economy that stopped with the 100-year pandemic, and that's on the top, right? You think your plan, oh, good, stocks will double over 7 years, which is kind of normal, actually. But then it felt like the bottom, didn't it? The reality, I guess we call it, right, Sonu?
Yeah, and with your eyes on the prize, and that's why there's a reason we call it managing your wealth during this period, as opposed to, it's not just investments, right? It's about how investments are serving your financial plan because, maybe you want to buy a boat, in 20 years when you retire, or you want to buy a second home, kids' college, and things like that. And those are the ultimate prizes. It's, there could be stuff that trips you up day in, day out. We've seen enough of that just in the month of August. Right. So, but at the end of the day, keep an eye on the prize. Are you on track? And that's what, financial advisors are here for as well.
No, exactly. That's why we get to work with financial advisors every day. And sometimes people say, what's my advisor's job really? Well, their job is in early August when we have that volatility and all that fear and all that stuff going on and everybody on TV telling you how bad it's going to get. Just as quickly we come back. And here's a spoiler alert. We're going to have more volatility. It's an election year. We're going to get into that. And here's a cool chart I think our team put together. Sonu, it goes back to 1900 on the Dow. So that's over 120 years if my math is right. A lot of bad things have happened. We're not minimizing bad things that have happened. We're not saying to ignore them. Obviously, some of these events outright caused recessions and bear markets. But the other thing to remember, just a few weeks ago in August, the Dow went back to new all-time highs. I mean, in the midst of all these negative things that we've seen, we've still hit all-time highs. Anything on this chart you want to add, Sonu?
No, it just shows how dynamic the U.S. economy is, how resilient it is, and it's really how resilient the people are and businesses, right? They adapt, right? Yeah. They adapt to new situations, and then that's how you get beyond crises.
Exactly. I mean, I don't know. I'm not sure of the exact numbers, but this is close enough for government work, so hopefully compliance is okay with this. If you look at our economy back in the 1940s and 50s, I mean, like half of it was manufacturing. We were a much different economy back then. Now manufacturing is less than 15% of the economy, more services based. What in the world does that mean? When you have a 100-year pandemic, and I believe it wasn't easy, but it's a little easier to start and stop and make agile changes in the way that our economy is. And that's what we've been seeing throughout history, right? We've been hit with a lot of things just on this screen. We've hit with a lot of bad things. But the good news, there's been a lot of good things, in fact, more good things that have happened, and we don't think this time will be any different. We'll continue to have worries out there, and it makes sense. We're talking about our money. We're talking about our retirements right here, so we're paid to worry. At the same time, let's remember that the good times are still going to come overall. Will Rogers quote. We've got some quotes for everyone here. I don't make jokes. I watch the government and report the facts. There you go, Sonu.
There you go. There's
All right,
good
so Sonu,
perspective.
what could happen? I mean, we could spend an hour on this. We're not going to, right? But I mean, different scenarios. If President Trump wins, and we joking, we made this with President Biden. We think a lot of potential or Vice President Harris's policies are going to be quite similar. But what stands out to you if so and so wins, if so and so doesn't win? What could all happen here?
I'll put this in perspective because especially now we are in that season of, I don't know what to say, maybe silly season of campaign promises. Everyone's promising something.
We just started that. We haven't been in that for about 120 years.
I know. Yes, there you go. There's some perspective for you.
Yeah.
120 years of campaign promises, right? That's par for the course. But whether it's I'll take care of food inflation, I'll take care of grocery prices, no taxes on tips, I'll eliminate taxes on Social Security, and there's a lot of stuff floating around. Reality is what you see on this page. Next year is going to be a big year for fiscal policy coming out of Washington, especially tax policy. Why? Because the Tax Cut and Jobs Act, which former President Trump signed into law in 2017, that cut the corporate tax rate from 35% to 21%, but it also cut a lot of individual tax rates, right? Now, the corporate tax cuts were permanent, but the individual tax cuts were not permanent. That's going to expire at the December 31st, 2025. So Congress has a massive job, and this is where Congress is important. It's not just about the presidential election. We're going to show you more charts on why, all the focus is on who becomes president. It's really about Congress too, right? They have to work together. And there's a good chance, maybe 50% chance that we get a split Congress, so everyone doesn't get their own pet favorite project. With the potential Harris administration, I think the biggest risk is maybe the corporate tax rate goes back up again. But again, that's in the scenario of a clean sweep. If Democrats control both houses of Congress and the presidency, right? Potential Harris administration. But I don't think the corporate tax rate goes back to 35%, maybe 28%. But here's where the dynamicism of U.S. businesses come in. They can work with that. It's not the end of the world. It maybe cause some market volatility here and there, but at the end of the day, I think a lot of the individual tax cuts will be kept in place with the potential Harris administration. Maybe some of the taxes on the wealthy, that will go up. But you take a potential Trump administration, he said he's going to keep all the tax cuts, right? Sure. And maybe even extend it. Maybe you drop the corporate tax rate down to 15%. So, there's a lot of policies there. There's a child tax credit. One thing, we'll talk about this in the, coming up in a few minutes as well. Defense spending. I think defense spending is already up more than 10, 12, 15% year over year. That's under the current Biden administration. I think that continues irrespective of whether it's a Trump administration or a Harris administration. At the end of the day, Ryan, you asked me what to focus on. Look at the last line, deficit spending. Everyone's talking about, every policy they're talking about, spend more money, right? All of the stuff over here, if you cut taxes, what happens? That means the government's bringing in less revenue, right? So at the end of the day, I think the deficit goes up. By the way, that is not a terrible thing as far as markets are concerned. And, I'm not saying it's good, bad, we can talk about that ad nauseum. But sure. In this business, you and I are focused on how will markets react to some of these policies, right? At the end of the day, deficits can contribute to profits, especially if it doesn't slow down private investment and consumption. We saw that between 2016 and 2019, right? We got enormous deficits. Deficits increased. Corporate profits went up. We saw that again in 2023, early part of 2024 as well. So I think we get more of the same, to be honest.
No, good stuff there. Obviously, President Trump, tariffs, right? I mean, he's been on record for 20 or 30 years talking about putting tariffs on China. You could argue, when he first slapped, I think it was washing machines. I think it was one of the first
South
things.
Korea,
yeah. I don't know why they say you slap a tariff on something. I have no idea why, but that's the lingo we use. We slapped a tariff. I believe it was like February 4th of 2018, early 2018. We had a heck of a rally right after the election of 2016. Yeah. All of 2017 was great. January 17 was pretty good, and then boom, once the tariff started, things got a little rockier. Now you could argue, and I would probably be in this camp, we had a heck of a run. Midterm years usually aren't all that great, but listen, at least initially, once those tariffs kind of came out, the markets didn't react so kindly. So anyway, we're watching all this very closely. Obviously, there's things that are out there, and we'll see where we are right after the election and things. We'll probably do another one of these after the election to give our real-time takes as well. But those are things to watch. Now, here's some interesting things, Sonu. Just the 4 years of a presidential cycle. Midterm years usually aren't all that great. The first year does pretty well, but you see the returns there. It's at pre-election year 3 of a president, like we just saw last year, is usually really strong. Well, stocks gained like over 20-something% last year. That played out. And then election years usually do okay, but let's take it a step further here. I'm going to come back. Where is it? I'm going to get to, here it is. I'll go backwards.
There we go.
There we go. This kind of breaks things down by if you have a lame duck president, have a new president. I think what's really fascinating is under a new president, so year 2 there, things don't do that well. Like President Trump, 2018, stocks were down. They didn't do so well. 2022.
Don't remind us.
Yeah, I know. Yeah, exactly. Stocks were down about 20% for the year. Bear market really, but the thing that was so unique about 22, bonds didn't do anything either, right? You remember what I'm talking about here when you got your statements. Bonds didn't give you much at all diversity, and bonds are down double digits. First time in history, stocks and bonds down double digits in 22. Let's move forward, though. Check it out. Look at that big green for year 3 on a new president. It's normal to see a big rally, and then historically, stocks do pretty darn good as well, up 12.2% when you have a president, a first-term president in the 4th year of their presidency. It's those lame duck presidents, years like 1960, what is it, 1960, 2000s in there, 2008 also, some lame duck presidents. Those years did not do very well. Anything you want to add on that, Sonu? I'm going to go backwards here and kind of take a look at this. What do you think?
It's funny because President Biden's are running for re-election. I don't know if former President Trump wins the election, will he be a one, will that be like a new term or a continuation?
I don't know.
Anyway, I'm just joking.
Yeah. Well, Garfield, I guess, right? I think Garfield did that, but it's very rare. It's very rare. But here's kind of your average election year. Now, let's be very clear. The time we're recording this has been a heck of a start for an election year, like the best start for any election year since 1976. Normally, you get all choked up talking about this. Normally, the first half of an election year is not that great. It's late. And you just think of the last couple elections, Sonu, 2016 and 2020, markets sold off pretty hard ahead of those elections, jitters, worries, but then once the uncertainty of the election was over, listen, markets can take good news, markets can take bad news, is the honest truth. They just don't like uncertainty. We saw big rallies after those. We've had a heck of a start to this year. I think we'd probably be kind of foolish and naive to think that the tricky months of September and October would just be smooth sailing. I think we're in the camp. We could have some more scary days, some more volatility, but once the election's over, probably get that year-end rally. What do you think?
No, I agree. I mean, what's interesting is if you look at the end of it, you see a 7.3% average return in election years, which is close to the historical average for stocks as well, I believe, right, Ryan?
Right.
And and that's with, 2008 being included in here, as well as 2000. Mm-hmm. So you had 2 years where he had a massive down year, and those are 2 recessionary years. We certainly don't think this year will be a recession. We'll see a recession this year. So that's your macroeconomic backdrop as well. So I bet if you exclude 2000 and 2008, that average number will probably look a little better.
Yeah, well, and in a way, you can say you do that when you have the president's first-term presidents because it goes to 12.2% on average, for sure. So Henry Kate VI said the problem with political jokes is they get elected. There you go. Again, we're making fun of both sides here. Please don't shoot the messenger. But here's what you were talking about, Sonu, on the right there. You're negative when you have a president up for re-election. I'm sorry, a lame duck president, apologies, versus a new president up 12.2%. We already talked about that, though. Yep. Churchill said Americans will do the right thing after they've tried everything else. Churchill. I believe there's like 1,102 biographies written about Winston Churchill, the most out of any human being in the world. So
I have one sitting on my shelf here.
Oh,
and a bunch of speeches by Churchill as well. So
that's good. So here's some interesting context, right? We knew these things coming into the year. And I already talked about it, up 12.2% on the right there, election years. When you look in history with the first-term president, things do pretty well. Okay, and that's clearly where we are this year. And now, normally, the thought is these presidents are going to run for re-election. So obviously, we have a little bit of a different with President Biden not running. And Sonu, I took a look. I forget the exact years, but there were 5 other times back to 1900 where the president could have run again, okay? And they chose not to for various reasons. LBJ 1968 is the most recent time. But the average return, I used the Dow actually because the Dow, we had data back then. The stocks gained like 16% on the year. Previous times, presidents just decided not to run for whatever reason. So to blindly say things are going to not do well because a new president steps down is simply not true, right?
No, exactly. And I'm just looking at the last 2 columns here, pre-election year.
A lot of green.
Election year, it's all, yeah, it's just a lot of green, right? And granted, this is for first-term presidents, but still, I mean, last year we did, 24%? And so far, year to date, as of this, we're speaking on the 27th of August, the S&P 500 is up 19%. So,
yeah.
So far, so good. I mean, who knows? The market may be green by the time we end this.
Yeah, so good stuff there. And another reason we potentially could have been strong this year, and this is what you just kind of talked about there, when you have a down midterm year, and again, midterm years, because think about it, year 1 of a new president, kind of excited, everybody's in a good mood. By the time you get to year 2, that's when you start to hit some problems. Maybe some of the promises you made aren't working, or different things, or you got to change your tune a little bit and do something here to make people mad. Whatever it is, this isn't about red or blue. This is just what history tells us. I mean, look at that. A bunch of times we've seen some big time drops in midterm years under presidents, and then but look what happened next, Sonu. 17 of the last pre-election and election years, stocks were higher. It's looking like this year is going to be 18. So that was kind of a clue, a signal, if you will, when at the start of last year, when nobody in their right mind was, well, I shouldn't say it like that, but it felt like nobody was bullish at the start of last year, because I know they weren't, because you and I were, right? Carson Group, our investment research team, was bullish last year, and this was one of those reasons. Hey, midterm years are bad, tend to get a snapback pre-election year, and sure enough, it's playing out along with the election year here.
I mean, what's interesting is, yes, obviously it's not a very big sample, but if something happens 17 out of 17 times or 18 out of 18 times, I'll take it.
Yeah, something I would not ignore. And then we broke it down at the bottom by Democrats and Republicans, but again, fairly small sample size, but you can see that there as well. And then let's say you gain 20% in a pre-election year, which we just did last time. You can see here, or last year, the election years, again, never been lower, up about double digits on average. At the start of this year, we came into the year thinking stocks were gaining between 10 to 12% or so, and a lot of these numbers kind of jive with that. Obviously, it's been even better. We've been bullish, don't get me wrong, but it's been even better than what we expected. We did upgrade, our view on equities to about 20% gain or so for the year at the middle of the year with our mid-year outlook. But anyway, when sometimes a good year can lead to a good year. Now there can be times when that doesn't play out. We get it, but we're going to talk about the economy and some of those things next. Why we still are optimistic, though, that this year is going to be solid for investors. Source unknown. George Washington was the only president who didn't blame the previous administration. That's another good one there.
Except for King George, maybe, right?
Yeah, that's true. That's true. So we get asked all the time, Sonu, okay, well, listen, who's better for stocks? Like, tell me the honest answer. Republicans or Democrats? Well, don't get too mad, because trust me, you're going to like my next answer if you don't like this first answer, or if you vice versa. But technically, stocks have done better under Democratic presidents, Sonu. We looked at this, and you can think about it, because, again, 2000 and 2008 were Republicans, right? And now would they have stopped, if Democrats were in office, would that really have stopped the tech bubble? Right. Would it really stop the GFC? Short answer is no. I mean, let's be honest, no. But it is what it is. So technically, stocks have done a little bit better, you can see, under Democrats and Republicans. Now, here's where it gets a little interesting, though. You could argue maybe you have more power if you control both chambers of Congress than who's in the White House. And in that particular case, we see stocks do a little bit better when Republicans control both chambers of Congress versus when the Democrats control both chambers of Congress. So what does all of it mean? We say it's not about red, not about blue, about green. Sonu, check it out on the right there. When you have a split Congress like we do now, the Democrats have, Democrats are 51-49, while the Republicans, that's the Senate, the Republicans have, I believe, a 4-seat majority in the House, the smallest in 140 years. That's a lot of gridlock. The old saying, gridlock is good when it comes to Washington because you can't get anything done. You get some stuff done. I'll ask you about that in a second. But the only stuff that gets done, both sides agree. Check it out. The last 13 years, stocks were higher. What has passed in the last couple of years, and why does that matter, you think?
I mean, part of it is one was a bipartisan infrastructure bill.
Yep.
And then we got the CHIPS Act, right? Which, one thing that came out of that is we've seen manufacturing construction surge, right? If you look at manufacturing construction facilities of, things that make factories potentially that make semiconductor chips or electric vehicle batteries, that's up more than 1,100% after adjusting for inflation since the end of 2020, right?
Sounds like a lot.
Yeah, exactly. Right. So that's things happening in the country, I think, that are very positive. I mean, it goes back to this is a very dynamic country. And I don't mean to say, or we don't mean to say that, what Congress does, what the president does, doesn't make a difference. It does, right? I mean, in so many ways, markets care about that. But also, one thing is, and goes to what this slide is trying to show, is that when you have complete control by one party, they tend to swing for the fences.
Sure.
And then there's a lot of uncertainty because both parties have people like, oh, I want this, this is my time, right? And then there's a lot of uncertainty because you're getting a big change in policy, whether it's tax policy or whatever it is. Whereas we have split party control, status quo, right?
Yeah.
Not much changes, and markets like that.
Well said there. And again, I think, like previous elections, you hear red waves or blue waves, and then things kind of come in a little bit more in the middle, so to speak, and you almost get that relief rally. Now, here's a really cool way to look at this. Our friends at Bespoke did this study. But if you had $1,000 and invested in 1953 when Eisenhower took office, and only invested when Republicans were the president, Sonu, you have about $27,000 today. You took that same 1,000 and did the same thing, but only when Democrats were in office. You'd have about 56 or 57,000. So it sounds like a good deal more. That's the power of compounding, right? If a couple percent a year over time, you're going to have a lot more money. But just have those two numbers in mind. If you took that same $1,000 and invested it the entire time, but just stayed invested, did not focus on who's in the White House and who's this, who's that, you'd have $1.7 million right now.
Boom.
And I know we are aware emotions are high with the election, and if so-and-so wins or so-and-so loses, what's it going to mean? Reach out to your advisor, but I'm pretty sure they're going to be telling you, don't mix politics with investments. Okay, I mean this whole webinar could have summed it up right there. I mean,
right?
honestly.
Yeah, that's a mic drop.
But the honest truth is, we're going to talk about the economy. If the economy is still strong, like we think it is, we'll get to that here pretty soon. That matters more than who's in the White House. We're not saying it doesn't matter, but for your investments, when you wake up, I believe that November 5th is the election, right? November 5th.
Yep.
So when you wake up November 6th, we'll see if we get the results, and we'll see if it's all in by then. But a split Congress, which is what we expect to see. At least we don't, but that's not our call. But a lot of really smart people in Washington that we follow and trust think it's possible. Because if you think about it, there's 100 seats in the Senate. 33 of them are up for re-election, okay? Or 33 are up for election, okay? 23 of those are Democrats that are defending their seats. So right away, that's what they call a tougher map. And a lot of those states are kind of those purplish states that President Trump actually did really well in 2016. So most people think, Sonu, 51-49, Democrats, right. Republicans probably are going to take the Senate. Now, the opposite of this is the House has a much easier path for the Democrats to take that back. So we very well might see a flip-flop, but at the end of the day, it's going to be gridlock. And even if it's a red wave or a blue wave, we don't think it's going to be that. It's going to be very small. So it's going to be probably in all likelihood very small lead if either party were to take both. But we think it's possible we see a flip-flop. What do you think about all that?
No, even if you get a red wave or blue wave, right? Mm-hmm. It's the majority
small
is going
wave.
to be so small.
Very small. It's like when you go to Great Wolf Lodge, the wave machine. That's not a wave. Those aren't big enough waves, Yeah.
and then you can see like one or two senators in that party that supposedly controls Congress.
Yeah.
We saw that in the late 2000s with late Senator John McCain went against his own party.
Sure.
We saw that lately with Senator Manchin from West Virginia, Senator Sinema from Arizona. So there are people in the middle who be like, no, we don't want to go that far, and that's where checks and balances come in.
Well said there. So let's see what else we have here. So Sam Stovall, old friend of us, he said the old saying goes, if the opposite of pro is con, then the opposite of progress must be Congress.
I laugh every time I see
I know, yeah, Sam's hilarious. But you can use that one, not just this year, but the rest of your life about opposite of pro is con. So just a little more color on this, and we already touched on it, but divided is a good thing. When it comes to Congress, you can see it's about 16% on average, and you have that split Congress versus if you have a unified Congress. Oh, what is that? about half of that or so. So again, we'll see. But in the last 13 years we've had divided Congress, the S&P 500 has been higher. And here's just some breakdowns. People like this stuff. We're not going to spend too much time on it. You can take a look at it there. But again, if the Republicans have a red wave, if it's split, who's in the White House, who's this and that. The honest truth, Sonu, also, some of these are very small sample sizes. So by no means are we saying invest in this. I think still the one that makes a lot of sense is that divided Congress, or at least very small majority in Congress, tends to matter a lot more for investors because, again, you don't just blindly spend a bunch of money on a lot of things. And believe me, if your party won, you probably want to spend money on those things. Right. At the same time, checks and balances are the way our forefathers want to design this thing a long, long time ago. What do you think?
No, exactly, right. And at the end of the day, keep your eyes on the prize. Stay invested. Sum it up.
That's true. And again, like we're going to talk about the economy next, maybe stay a little more invested if the economy is strong,
right,
which is where we're working our way to. Mark Twain said, if voting made any difference, they wouldn't let us do it. That's a good one by Mark Twain there. All right, so we're going to talk about the economy. There's Jerome Powell. He's in charge of the Fed. He just talked at Jackson Hole recently. We don't want to get too in the geeky weeds of this. But Sonu, what's Fed policy and what's the economy? How does it all look right now?
Right now, I would say, look, the labor market, we've gotten recent numbers. Look, why is I should start there. Why is the labor market important? Because that's where incomes come from. Why is income important? Because that's what drives consumption. Consumption makes up 70% of the economy. Yep. The labor market is slowing down. I don't think we're in a very troublesome place, but it is slowing. There's downward momentum, but that's where the Fed comes in, right? Interest rates are 5.5%. They raised interest rates to fight inflation over the last couple of years or through last year. Inflation's fallen. Like you and I have talked about inflation being last year's problem, which is not to say prices are not higher. No, we completely get it. Prices are 20% higher than they were before the pandemic, right? If you go back and look at food prices, vehicle prices, used cars, new vehicles, whatever it is, right? But inflation has eased, right? It was running at 9% in June of 2022. That's pulled back to somewhere between 2.5% if you look at the Federal Reserve's preferred metric of inflation, which is the personal consumption expenditures index. And so they're literally on the verge of cutting interest rates. That's going to boost certain parts of the economy, especially the most cyclical parts of the economy, like housing, for example. I mean, if you know anyone out there who's looking for a mortgage, they're probably staring at 6.5% interest rates. This time next year, who knows? I mean, I'm not saying this is a guarantee it'll happen, or if the Federal Reserve lowers rates, maybe mortgage rates are at 5.5%. What do you think that does to housing relative to what's happening right now? So a lot of things, there are some tailwinds for the economy right now, and as a result for the market as well.
I'll just jump in and refis, right? I mean, just in the middle of August or so, we saw interest rates go down, right? We had the issues with Japan and things, so interest rates went lower. And refis went up 34% week over week. Now, believe me, they're historically low. So, but if you bought a house last couple of years and you've been looking to refi, all of a sudden it's there. So that could unlock a lot of potential for the economy. Also, small businesses. Small businesses make up 55% of all the workers. Okay, so we talk about these big companies, and the big companies matter because they create a lot of the earnings. But we are not lost on the fact that small businesses matter so much in our country. 55% of them, again, all the people that work, 55% of small businesses. Historically speaking, higher interest rates are not good for small businesses. I'm sure there's some small business owners listening right now saying, yeah, it's true. It's harder to get financing. Things are more expensive. We want some lower interest rates. And small businesses, there's different surveys. And believe me, we're always a little skeptical when it comes to surveys. But some small business survey we look at just hit 2-year highs because people are seeing the idea that interest rates can go lower. That could be a big tailwind for small businesses. So those two things are really important when it comes to the economy. What's also important, Sonu, earnings and profit margins. Yeah. We can talk about this all day too, but the bottom line, we've got record earnings. We just finished up earnings season. Once again, really, really solid. Forward 12-month earnings are expected to hit the highest number they've ever hit. So earnings are there, and profit margins are justifying it too. We were told 2 years ago profit margins only had one way to go, down. That didn't happen. I think that's one reason why stocks have been so strong the last 2 years. What do you think?
And this is what's essentially driving market returns. Somebody says, oh, the market is up more than 20% last year, 19% so far year to date. This year, are we in a bubble? Well, you look at the charts here. No, clearly not in a bubble because it's really profits that's running the economy, running the market. And you think about the economy, and it is true that the stock market's not the economy is not the stock market, but the connection between the two is profits. Profits come from the economy. That's what companies care about. That's what investors care about. Over the long run, it's really profits that matter. And so far, profits are looking good. Profits are growing. And you can break down profits into sales and profit margins. Sales, obviously, nominal GDP growth is running about 4.5%, 5%. So sales are going to be rising. But at the same time, what we're seeing is corporate America has done a lot to become more, I'd say productive in a lot of ways, in more ways than one. And they have a lot of what I call operating leverage. That means when sales increase, their margins are also increasing. That's what's driving profits higher. That's really positive for the economy and markets.
Well said. I mean, I've said many times that this is kind of the dual tailwind, if you will. Higher profit margins and higher earnings likely suggest that stocks are probably going to continue to move higher. Eventually, those two things will roll over. We'll be there when it happens. We don't know when it's going to happen, but the truth, again, the economy has been growing nicely. Are things slowing down? Yes, things are slowing down a little bit here, but we weren't always going to grow as fast as we did last year. We weren't always going to hire 300,000-400,000 jobs a month like we did the previous couple of years. Things are more normalizing in our opinion. Alfonso Carr said, the more things change, the more they are the same. We've probably heard this, the more they stay the same as well. Sonu, we can talk all day about what's going to change, but maybe for investors, what's going to stay the same, regardless of who wins the election, where I'm going with this. Let's talk about some of those things. Let's talk about defense spending. What do you think?
Yeah, defense spending, as I mentioned a little while ago, it's been rising, right? It's been rising. Like through January of this year, it was up 14%. Right now, it's up about 15, 16% year over year as of the latest data, through June and July. But the other side is defense spending, pulling back the horizon all the way, historically, right? It's just 3.6% of GDP right now. Which means it's got a long way to go to get back to some sort of historical average. Even if it doesn't get there, I think over the next, let's say 5 years, decade, we are actually going to see more defense spending, and that's going to likely to continue irrespective of who wins the election.
Yeah, I mean, this time a year ago, defense spending as a percent of GDP. GDP is our economy, right? So you can say, well, we're spending a lot. Yeah, well, our economy is $25 trillion also. And just look around the world, look at what's going on out there. We think defense spending is probably going to increase no matter who's in the White House. Also, the U.S., I think it's quietly, they get some play, but we are like the world's largest oil producer here. And you think that's probably going to stay the same no matter what?
No, I absolutely. And as long as oil prices, this is where OPEC, which is a cartel with Saudi Arabia, UAE, and OPEC Plus has Russia also. Every time they try to keep prices high by cutting their own production, U.S. oil producers step into the gap and increase production to the extent that we are producing record million barrels per day. This was, when we put this data on this deck, it was 13.3 million barrels per day. Right now, it's about 13.4, right? Production's double. Look at that. It's doubled from 2011 levels. And production fell back during recessions. That's not surprising. We saw that in 2015, 2016, and 2020 as well during the pandemic. But that's another sign that oil producers continue to produce record levels of oil, and they don't see a recession either.
Mm-hmm. Yeah, the vicious bear market and recession of 73, 74, that was because there's an oil shock, right? OPEC and different things. I'll get too in the weeds of it, but oil shock, and that really hurt the global economy. Let's just put it that way. Vicious bear market as well. Now, you hate to say the four most dangerous words. This time is different. Sir John Templeton, this time is different. But listen, if we had another oil shock, the U.S. can do some things to kind of fight back, if you will. I mean, just when the terrible issues started in the Middle East last October, we saw an initial oil spike, no doubt about it. But then again, the U.S. is in a little different situation where we are pumping out a lot of oil, and we could do more if we wanted, right? So we could combat some of those higher oil prices, which obviously no one wants to see. Budget deficits, we've seen, obviously, President Trump didn't have too many problems with budget deficits. Obviously,
nobody
Vice President Harris.
Yeah,
Vice President Harris, and President Biden don't have too much of a problem with budget deficits. Talk to me, Sonu, about why we think those could stay high no matter what.
Look, like I mentioned, there's a big fiscal cliff, if you may, ending on December 31st, 2025, which means every American will see a tax increase come January 1st, when they get their first paycheck in January of 2026, they're going to see less take-home pay, right? So, and guess what 2026 is? It's an election year. Right. So what
midterm year, which usually aren't that great, to be honest. We talked about that. So yeah,
right.
remember that.
So I mean, all signs point to, look, they're going to renew most, if not all, depending on who's in power. It'll be most versus all. Going to renew most of those tax cuts, but that also means if you here's some numbers, right? I know there's a few numbers on the chart too, but if the entirety of those individual tax cuts are renewed, we are looking at the deficit increasing over the next 10 years by about $4 to $5 trillion. Right? I'll just leave it at that. So
there's a big room in the middle too, 4 to 5. That's a big number. There's $1 trillion in the middle there.
Yes. Look, everyone complains about deficits. I'm not too happy about it either. But look, on an individual level and for politicians to get reelected, nobody's letting taxes go up.
Yeah. Okay. Good stuff there. Well said. We've got a couple more things here. We're going to kind of wind it down. George Carlin said bipartisan usually means larger than usual deception is being carried out. George is awesome. I mean, they would cancel him in a second anymore, but I think he'd be awesome right now in today's environment. So, listen, we can get geeky with this. Maybe we'll keep it high level. The U.S. dollar will still remain the world's reserve currency. What did we see in March of 20, everyone? Stocks sold off, bonds sold off, even gold sold off. You know what went higher March of 2020? The cleanest shirt in the dirty laundry, the U.S. dollar. Now the dollar's been a little weak-ish lately. I think that's fine because historically, when the you-know-what hits the fan, that's when the dollar finds a bid, geeky word for meaning people move into it. We think that we still the world's reserve currency. As long as anyone listening to this, we're going to have the world's reserve currency. I get asked all the time when I present, well, I heard China and Russia and some other places are getting together to knock off the U.S. dollar as the world's reserve currency. Spoiler alert, as long as there have been currencies, there have been currency wars. Maybe you didn't hear about it, but it's always been happening. We're optimistic that we still have the world's reserve currency. But honestly, Sonu, a little weak dollar is fine because think about 22. The first 10 months of 22, I talked about it, horrible for bonds and stocks. The U.S. dollar had a historic run in the first 10 months of 2022. So we think we still have the world's reserve currency. Kind of hard to say late in the afternoon. You want to add anything to that, or did I sum it up okay?
No, absolutely. I mean, from a market perspective, if the dollar weakens, and it's likely to weaken, especially as the Fed drops interest rates.
True.
That's not bad for U.S. companies, actually, because a lot of U.S. companies make money outside the U.S., right? A weaker dollar means they're earning more outside. That means they're earning more revenues, more profits. Right, so it's not I think a good chunk of close to 50% of S&P 500 revenues actually come from outside the U.S. Right, it just goes to show that these are massive multinational companies that are potentially impacted by a strong versus a weak dollar. But with respect to reserve currency, if you just look at the notes on the slide, at the end of the day, we have the biggest financial market in the world, the biggest economy in the world. And these are deeply liquid financial markets. What do you need when you're invested in financial markets? You need them to be liquid. You need to be able to buy and sell things easily. The dollar allows you to do that, right? And the U.S. doesn't put restrictions on moving capital in and out of the country. A lot of other countries do, including China, by the way, right? China's sort of like Hotel California. You can move your money in, but it's very hard getting out. Yeah. So, and then at the end of the day, yes, I know politics, all of that, everyone's got some complaint one way or the other about the courts and et cetera, et cetera. But look, at the end of the day, big picture, we have strong rule of law, strong property rights, and most importantly, a history of enforcing these, right? I think this is why the world trusts America. The world trusts the dollar.
Yeah, no, well said there. The best argument against democracy is a 5-minute conversation with the average voter, or second Winston Churchill.
Hopefully not the two of us, but
Exactly. So, we've already talked about the U.S. dollar. What do you want to add about foreigners in the U.S. dollar here?
No, this gets to the point about, what about the Saudis and the Chinese and the Indians saying we don't want to use the dollar anymore? Well, what else are they going to use, right? Look, everyone wants to, for most other countries, this is a generalization, but I think it's a good generalization. Their economies work by selling stuff to us, right? And what do we give them in return? We give them dollars. What do they do with the dollars? Well, they can say, I don't want to hold dollars. I'm going to sell it to somebody else. But then someone else is holding the dollars, right? The Chinese says, it's a hot potato. We don't want dollars. We'll sell it to the Indians. Now the Indians have dollars, and the Chinese have the Indian rupees, for example. But then the question is, do the Chinese want to hold Indian rupees? No, they don't want to hold Indian rupees. And the other thing is, so they keep the dollars, and what do they do with the dollars? They come and buy U.S. financial assets, like treasuries, right? And that's why the dollar is likely, because we are the largest economy in the world. Most people's economies, most other countries' economies function literally by selling stuff to us, unless they change the economic model where they purchase as much as they sell to us. Like, so our exports and imports are sort of in balance. What you see on the chart is it's in heavy imbalance. Our imports are much larger than our exports. That's because the rest of the world doesn't want to buy much stuff from us. In fact, it'll not be a bad thing if they start buying more from us. It's good for our exporters. It's good for our manufacturers. But unless other countries like China, Germany, South Korea, Taiwan start to, their consumers start to spend more, and their consumers have more purchasing power in which they can buy American goods, we're going to see the dollar continuing to be the dominant trade currency in the world.
So, I know we're getting close to the end. You were just in Europe. They still took our dollar there, right?
Yeah, and it's amazing how much, dare I say, maybe it's because I'm coming from Chicago, but things are a lot cheaper. Not a bad time to visit.
Well said. And I think this is probably our last slide here. Let's wrap it up with this. George Carlin told us, in America, anyone can become president. That's the problem. So there's our final disclosure here, Sonu. Any final comments, Sonu? Because we are at the bottom of the hour here. We kind of need to wrap this up in a minute or two. But this was a lot of fun, Sonu. I appreciate you taking the time and say a few words. Yeah.
No, I think just circling back to where we started, is about managing your wealth, right? And keeping your eyes on the prize. What's your eyes on the prize? We like to say, at Carson, find your freedom, right? What allows you to find your freedoms, right? Whether, like I said, whether it's buying that boat or the second home or, throwing a big party for your children and grandchildren, whatever that is, however that freedom is defined, it's not just about investments and money. That should just be, a means to that end, right? And at the end of the day, look, there's a lot of volatility that's thrown at U.S. consumers, U.S. businesses, but historically, as we've seen, everyone's adapted.
Mm-hmm. Oh, well said there. This was a lot of fun. Hope you guys got a lot out of it. I said about our team, right? We're not always going to be right. We're not always going to be wrong. But we're going to be the most transparent team there is out there on Wall Street, and we're going to continue to do this. The data can change. If the data changes, we'll change along with it. But the bottom line, like you said there, Sonu, the economy continues to remain resilient. We're still in a bull market. Yes, this election is going to be contentious. Yes, people are not going to be happy when everything is all said and done. But let's just remember that we've had good times before. We're going to continue to have good times. We're going to continue to get through them, and to separate our political beliefs from our investments. It's very, very important. Not easy to do, but very important. So with all that, we're going to continue to do these special webinars as long as everyone keeps attending them. So thank you so much from the Carson Investment Research team and all of Carson Group in general. We really appreciate everyone spending some time with us this afternoon. And who's going to win, Sonu? No, I'm just kidding. We're going to leave it there. We're going to leave it on that one. We're going to leave right there. We'll see everybody next time. Take care. Yeah, I know. Thank you, everyone. Take care.